From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli alongside Sue Lannon. And Sue, really a very positive session today as we started to see these expectations. Maybe we'll get some rate relief in February.
Yeah, investors were very positive about the latest inflation figures which came out today. So as you can see, the CBO 200 jumped 1%. The ASX 200 is up by a similar amount. The thing with the inflation figures is that core inflation, which strips out the volatile items, and the figure that the RBA watches has come down. So it's rose by 3.2% over the year to November. That's down from a rise of 3.5% over the year to October. So it does suggest that these interest rate cuts, 13 interest rate cuts that the RBA imposed from 2022 to 2023 have worked their way through the economy, and they are slowing inflation. Inflation, of course, hit a high of around 8% in around December 2022.
Yeah, absolutely. So really our main theme of the day. And then, of course, that really led through into that inflationary boost into the market too. Next up, of course, is going to be the Fed minutes. We get the release of the Federal Reserve's December minutes. And kind of interesting with that data that you had out of the US overnight as well, Sue, as to whether or not there might be quite a bit of a pause now coming through, whether or not the Fed is done for at least a little while. I think I had one guest today saying potentially not till maybe June, July, you see another cut there.
Well, certainly the economy in the US is holding up well. We had some services industry figures out overnight, so that did give investors pause as to how many rate cuts the Fed will put in place this year, and two predicted, but when will that be?
All right, let's get into the themes then, because as we mentioned, very solid session on the market, up by around 1% when it comes to the sectors. REITs, having a look at those, a little bit under pressure. Goodman Group down by 0.4%. Just flipping the board though, I really wanted to take a look at the banks if we just flip quickly through to those, because CBA at one point, Sue, up another 2%. I mean, this is a stock that just does not seem to have its brakes on. Every time people say it's a sell at these levels, people continue to buy into the banks.
Yeah, that's right. Overvalued, many people say. And looking at retail stocks now, Wesfarmers jumped 1.8%, JB Hi-Fi up 0.6%, Harvey Norman rose 1.3%, Premier Investments rose 0.5%, and our favourite jewellery store, Lavisa, fell down 2%.
Maybe that's because people aren't buying Christmas earrings. But yeah, really interesting to see the big moves in those consumer stocks as we potentially look for some rate cuts. Let's have a quick look at some of the other movers. Regis, West African, both moving higher there on quarterly updates. I spoke to the Regal Partners CEO. Now, of course, they walked away from Platinum towards the end of last year. He said they're still looking for some really good growth opportunities. The shares, though, falling despite the fact that Regal actually came through with a record in terms of funds under management for the December quarter.
And we saw Avita Medical fall around 20%. That's after the regenerative medicine business downgraded its commercial revenue guidance for 2024. That's thanks to slower purchasing activity.
All right, let's get our guest for the COB, Mark Gardner from MPC Markets, joining us. Good to see you, Mark. Your thoughts on how we saw the market sort of price that inflation print, because we were looking pretty flat to negative and then it just took off at 11:30.
Yeah, I suppose there's been a bit of talk about inflation of late, particularly from the Fed, the market was probably a little bit scared that there might have been a high number, and probably a little bit of relief overall that there wasn't. But we still are in pretty thin market conditions. You can sort of see with the big four and go heading up again today, and particularly that CBA, it's just that index buying yet again. I don't think you've got any, you certainly wouldn't have any value-based funds or fundamental funds buying any of these big four banks and some of these retail stocks here at the moment. But that flow of money with the increased amount of super coming in, combined with thin markets, it obviously just, it's very easy for those things just to head higher. But obviously, as we pointed out enough of times last year, you know, momentum works both ways, and you were unlikely to find a bid from any of the valuation-based funds for significant points lower if that momentum turns around. So very happy to see those, let those pass us by at the moment, because I don't think there's going to be a hell of a lot of support for them in the event the market ever, turns around.
And Mark, do you think the market is being over optimistic on a possible rate cut in February? Really sort of boosted stocks today.
Yes, absolutely, and we've been saying the market's been overly optimistic on rate cuts for about a year now, and last year we were proven to be right. We've always sort of stuck to late Q1, early, sometime in Q2. But to be honest, I think we really are. We see these Fed minutes come out. There has been a couple of comments about inflation in the States maybe being more stubborn from a few Fed members. We saw a higher than expected inflation number in Europe recently as well, I think out of Germany. So if inflation starts to head back up, we could miss the easing cycle completely. And in all reality, I think the talk about rate cuts is it's mainly self-serving. It's a lot of fund managers and economists and banks who are all very geared to rates being lower. It's more about them wishing for rate cuts than there actually being a justifiable reason for them. So, pre-2007, most central banks would have been looking at holding rates steady or even hiking with the economic numbers we've got. I think people have just lost a little bit of context in the last 15 years because they've been so easy. They've been on zero rates, and it's really suited their business model. But in all reality, the RBA doesn't need to move at all.
Yeah, indeed. There's been quite a few in that camp saying maybe we do miss the cycle. When it comes to what we're seeing in the US, let's just talk about some of the movement that we've seen in government bond yields, because US job openings are 6-month high. We've got the Fed minutes coming through tonight, Mark.
Yeah, Fed minutes will be a little bit backward looking. The talk around inflation's really only been, I think Michelle Bowman was the only one in December. I think Mary Daly mentioned something about it, and I think we've had another Fed member, one of the newer Fed members mentioned something about it recently. So that talk of inflation's only come in very recently. And I really do think that even though they've cut 100 basis points, we're very close to, if not at 15 to 18-month highs in both the 2s and the 10s and the 30s as well. And beyond those highs, we're getting out to 15 to 17-year highs in those bond yields. So the market at the moment, I don't think you need to take any major signs from the first real week of trading this week, because in all reality, if we get those bond yields, particularly in the States, above 5%, I think the wind can be taken out of the sails of any potential rally moving forward very, very quickly.
Big gains from some of the gold miners today, Bellevue Gold and Regis Resources. So has gold got more to run?
Yeah, I think gold's got more to run, but I mean, more so particularly the store of value. I think gold, silver, to a certain extent, Bitcoin, because I think the reality of Trump coming in, I mean, look at the erratic nature. They're buying Greenland, they're renaming the Gulf of Mexico. I mean, realistically, there's no policy in there. It's just absurd talk. And if that US debt is not seriously addressed, there's going to be an absolute. People will be jumping ship from the US dollar quicker than, at an absolute rate of knots. So, and then you'll see an absolute float of gold, silver, and those store of values, because, there's consequences to printing a lot of money over the last couple of decades and then, and basically just gorging on government debt. So if they don't address it and they don't improve, they'll end up with a credit downgrade. We're looking at, Yellen was talking about, potential hitting the debt ceiling limit just before Trump goes in. So I think people were starting to pull away from the optimism of the Trump trade and look at the reality is that if they don't address those core structural issues in the economy, the US dollar's in trouble.
Mark, your thoughts on CBA? I mean, we talked so much last year about the banks are so overpriced and it wasn't going to be there this year. Then CBA just rises nearly like a cool 2% again today.
Yeah, as I said, I think honestly, and it was something that, we're seeing more and more people write about. I think Henry Jennings did a really good segment on it last year as well, is that 10 to 11 cents of every dollar that gets put into an ETF in Australia now, particularly with the increase in super, has to go into CBA. And an ETF index fund doesn't care what price it pays. So there is no sense of valuation. They just have to track the index. So that money's kind of blind leading the blind in a way, and it really has run out of sellers because it's been overvalued for quite some time. So conversely, that momentum can work against you really, really badly on the downside as well, because you're not going to have anyone with a fundamental view or a valuation view buying that until probably about $120. But it really is just the flow of money as it stands at the moment. It is overpriced, but things can remain irrational for long periods of time until the market's hand is forced to make a call on it. And I think you'll find that any real sort of support for that stock's going to be about 25% lower.
All right, Mark, thank you as always. Stay dry. Very, very wet day in Sydney today.
Thank you.
Mark Gardner from MPC Markets. Now, the stock of the day on the call, Sue, was Regal Partners. Mark's colleague, Jonathan Takadina, also from MPC Markets, joined me, along with Andrew Weilant from DP Wealth Advisory.
It has pulled back after that bid, but it still stays steady around that 360. So yeah, obviously Regal has dodged the bullet there. Platinum wishes they hit the bid, and yeah, there you go. So that's the story of how it goes. Mark often says that funds management is a popularity contest, and obviously Regal have been doing well in the last couple of years. Fund managers in general,
they've done very well. The platinum bid was going to be opportunistic, as we've heard. They looked under the hood and said thanks, but no thanks. So, to Jonathan's point, they probably have dodged a bullet. But I like Regal. I like the team. Phil King, a lot of time for him. So certainly this would be a buy.
Let's have a look at some of the movers now. Turning to the market leaders, we talked about gold prices. Bellevue Gold jumped up 6.8%. Genesis Minerals rose 5%. West Gold Resources rose 5%. Regis Resources put on 4.8%, and West African Resources rose 4.7%.
Yeah, and a lot of those gains coming after they had their pretty good quarterly updates as well. Let's have a look at the laggards today. Some weakness or profit taking coming through in some of these uranium players and also the tech players, so following through from what we saw on Wall Street. Zip and Block both lower. Paladin, deep yellow down in that uranium energy space, and HMC Capital off 4.5%.
Let's have a look at some other stocks. MTM Critical Minerals, small caps rose nearly 17%. Also Cell put on 13.7%. Mika Metals rose 10.3%. Grinks Metals rose 10.3%, and Anterius Technologies put on 9.5%.
And the downside, or laggards we should say, in the small cap land, Avita Medical. Now, the regenerative medicine business downgrading its commercial revenue guidance. So it says that's due to slower purchasing activity of its products. So it was one of the worst performers, down about 19%. 4D Medical, of course, had a big jump the other day, taking back today by 11%. E-Road, Orion Minerals, and Playside Studios also coming under pressure today. Looking ahead to what we're going to get tonight, Sue.
Yeah, we've got the minutes from the latest meeting of the US Federal Reserve, so we'll get more insights as to how the Fed is thinking in terms of possible interest rate cuts this year. Also, the US ADP employment change, so that's the measure of private sector employment, very important before the all-important non-farm payrolls on Friday.
Yep, and payrolls, the private ones, expected to increase tomorrow. Locally, we have got retail trade, so another sort of print for the RBA to see how we are faring. I know when I'm out there shopping, it looks very busy. International goods trade for November as well. So a recap on the market that we've discussed at length here. You can really just see how we were trading sideways, not really going anywhere until 11:30 when that inflation print came through. The fact that core inflation is cooling, suggesting to some that maybe we could see a February rate cut. Interestingly, Mark Gardner obviously saying he doesn't think so, but Citi also out, Sue, with a note saying they think a February rate cut is unlikely as well.
Well, the Reserve Bank's been really cautious, and it has definitely been tempering inflation, I think, expectations. I think we saw that in December. So it could be that they're waiting to see the December quarter figures.
Absolutely. Now, before we go, don't forget, of course, we've got High Conviction coming up on January 30. You can register going to ausbiz.co/conviction, but we'll leave it for now and see you from 9:45 Eastern tomorrow.
Goodbye.